I own a private equity firm, Limitless Capital, that specializes in buying and partnering with marketing agencies. And here's the thing, most agency owners really have no idea what we are actually looking for, what firms are looking for. They believe if they just hit a certain revenue number that their agency is automatically sellable. They believe that having clients and doing good work is enough, but it's not that simple. My name is Gil Valerio, and I built and sold my own agency. I built it from zero to over $500,000 in monthly revenue, and I exited that agency in a multi-million-dollar deal. And now I'm on the other side of the table. I partner with and acquire agencies as part of a larger portfolio roll-up. So today, I'm going to give you the inside perspective on what private equity firms actually evaluate when we are looking at agencies. So let's break this down. Private equity at its core is about acquiring businesses, improving their operations, increasing their value, and then eventually selling them for a significant return. That is the general model, but there are different structures and formats depending on the firm. One thing private equity firms like to do is acquire multiple businesses and then combine them into a larger portfolio. And sometimes that means consolidating operations across different companies, and sometimes it means formally merging those businesses together. Their goal is to increase the overall enterprise value of those businesses and then sell them as a larger, more valuable asset. Marketing agencies are especially attractive to private equity for a few different reasons. First is recurring revenue. Agencies typically operate on retainers or long-term contracts, which creates predictable cash flow. Second, there is consistent demand. Social media use and online marketing continues to grow year over year. Everything from local businesses, service-based businesses, coaches, consultants, e-commerce, they all need digital marketing services. And third, the market is extremely fragmented. That fragmentation creates opportunities to consolidate agencies and build platforms. From an acquisition standpoint, personally, we look to buy agencies anywhere from 2 to 4 times their trailing 12-month EBITDA. And from there, we focus on consolidating operations, improving their margins, and scaling the business. And once that happens, we may sell that agency or a group of agencies as part of a larger portfolio at, say, 6 to 8 times EBITDA multiple. That is how you create 3 times or a larger return in roughly 2 to 5 years. Now, selling as part or selling an entire portfolio is not a simple process, but even for agencies that aren't a fit for a full roll-up, there are still opportunities. We also do minority acquisitions where we come in as a minority partner. The CEO stays in place in that agency, and we invest capital, systems, time, and operational support to help scale the business. And this is exactly what I did with my first acquisition. And in under a year, we nearly doubled the size of that company and increased the enterprise value by 4 times. Now, let's talk about the 5 core criteria private equity firms use to evaluate agencies. So number 1 is revenue size, growth, and quality. This is the first filter. If an agency doesn't pass here, then nothing else really matters. Private equity looks for a certain level of trailing 12-month EBITDA, not just top-line revenue. The exact threshold depends on the fund size. Smaller firms may look at lower EBITDA ranges, while institutional buyers look for higher numbers. Beyond size, growth trajectory also matters. Buyers want to see consistent year-over-year growth, ideally in the 15 to 30% range or higher. But quality of revenue is just as important. And that means that recurring or retainer-based revenue, low churn, and limited dependency on any single client is all key. Stability is key. Private equity firms want to see stability in operations, stability in revenue, and the ability to consistently acquire new clients. Depending on the deal structure, whether it's a minority partnership, majority acquisition, or a full buyout, that criteria might shift slightly. In a minority partnership where the founder stays on, founder dependency initially is less of a concern. But in a majority or a full acquisition, buyers are asking a different question. If that founder steps back, what happens to the business? Is there a transition period? Can new leadership step in without revenue dropping or the business going backwards? And criteria number 2 is EBITDA and margin structure. Private equity buys cash flow, not vanity metrics. They care deeply about EBITDA margins, typically in the 15 to 30% range or higher. Clean, normalized financials matter, as do clear add backs like owner compensation or one-time expenses. expenses. Your EBITDA determines the purchase price. Strong margins create room for leverage, reinvestment, and roll-up synergy, where weak margins raise red flags, especially when profitability depends on the founder doing all the work, or bloated payroll, or unclear expense tracking. Criteria number 3 is systems, processes, and team dependence. Private equity does not want to buy a job. They want to see documented systems, clear SOPs, and a management layer that can run the business, the day-to-day operations. Sales, operations, and delivery should not live entirely in the head of the founder or any other team member. So the core question that buyers are asking is simple. If you, the founder, disappear tomorrow, would that business still run successfully? And if the founder closes all the sales, manages the accounts, and runs fulfillment, that is a huge risk. Criteria number 4 is scalability and platform potential. This is where multiple expansion happens. PE firms love agencies that serve large, fragmented markets and can be duplicated across niches, regions, or service lines. Agencies with standardized delivery, proprietary processes, or platform potential stand out. Examples include niche agencies that can bolt on smaller competitors, agencies with proprietary technology or data advantages, and agencies that are positioned as enterprise-ready partners. Small or tiny total addressable markets, highly custom delivery, or growth strategies that rely on running more ads limit the upside of that business. Criteria number 5, strategic fit and exit optionality. Private equity is always thinking 2 moves ahead. They have to. They evaluate how an agency fits into an existing portfolio, whether it increases the combined EBITDA, and how it improves the future exit story. The goal is simple: buy at a lower multiple and sell at a higher multiple as part of a larger, more valuable portfolio. Agencies that can't integrate, don't improve the exit narrative, or have founders unwilling to stay through a transition period all raises red flags. By the way, if you are running an agency and you want to position it not just to be sellable, but to actually attract institutional level buyers like private equity firms, this is exactly what we help with. A lot of agencies assume that once they're making money, they can just call up a broker, list their agency, and that's the whole process. But the truth is, there's a lot more that goes into structuring an agency to be truly sellable. If you want to learn more about how we've worked with over 100 agencies and how we positioned our own agencies for successful exits, click the link in the description. Now let's discuss the red flags that make agencies unsellable. So red flag number 1, no documented systems. If everything lives in the founder's head, there is very little transferable value. Buyers want to see SOPs for everything: service delivery, client onboarding, sales workflows, hiring, and quality control. Documentation should be organized, detailed, and repeatable. When a buyer can click into a client onboarding SOP and see step-by-step instructions, screenshots, templates, all that proves systematization. Red flag number 2 is inconsistent revenue. If revenue swings 30 to 40% month over month, all that signals is unpredictable cash flow. Buyers want recurring contracts, predictable client acquisition, low churn, and consistent performance. Red flag number 3 is no scalable client acquisition system. If the growth of the agency relies entirely on referrals or the founder's personal network, none of that is transferable. Private equity wants to see a documented acquisition system, paid ads, partnerships, outbound, or another repeatable channel. That all works without the founder being the rainmaker. Red flag number 4 is poor financial records. If you can't produce clean financials for the past 2 to 3 years, due diligence becomes extremely difficult or impossible. Buyers want to see profit and loss statements, balance sheets, and cash flow statements that are clean, accurate, and reviewed by a CPA. Red flag number 5, poor profit margins. Even with everything else in place, weak margins will kill valuation. Healthy agencies have room for profitability after paying market rate compensation. If expenses are bloated or margins are thin, buyers will question sustainability and they'll reduce the multiple applied to your agency. So that is what private equity firms, including my own firm, and even individual buyers are actually looking for when they buy an agency. Your EBITDA is the money that you make month over month, but your enterprise value is what someone pays to own, acquire, or partner with your business, with your agency. And when we look specifically at agencies, we are paying for systems, predictability, growth potential, and independence from the founder. If you are serious about eventually selling your agency, whether it be to PE, an institutional buyer, or even an individual, you need to start building with the end in mind today, right now. Build systems so that the business can run without you. Document everything so that it is transferable. Maintain clean financials so due diligence is smooth and you know your numbers and your value. The agencies that command the highest multiples are the ones that don't actually need to sell. They are systematized, they are growing, and they are profitable, which is what makes them extremely valuable assets. And that is exactly what we do. We've done it with over 100 agencies, and we do it in our own portfolio, in our own agencies. We install a 7-step system that not only helps agencies acquire 10 to 25 high-ticket clients every single month, but is built on a foundation that turns an agency into a sellable asset. If you want help building an agency that private equity firms will compete to acquire, click the first link in the description.